On international business news, Asian markets slipped on Monday at the start of a key week for equities as the Federal Reserve prepares to lift interest rates again and some of the world's biggest companies report earnings. While the U.S. Central Bank is widely expected to hike borrowing costs by 75 basis points, traders will be poring over policymakers' views on the outlook for the world's biggest economy as they try to rein in inflation while nurturing growth. Now, the decision comes a day before second quarter gross domestic product data is released, with some observers warning it should or could show a second successive contraction, which is considered a technical recession. All three main indexes on Wall Street ended last week with a loss, ending a three-day rally following a big data miss on the crucial services sector. In a related development, the Korean won looks set to extend declines from its recent 13-year low as South Korea's trade balance worsens and foreign investors pull money out of the nation's stock market. Repeated interest rate hikes by the Bank of Korea haven't been enough to stem the rot, with the won dropping about 9% this year as global investors shift into dollar assets. It is among Asia's worst performance as investors increasingly focus on the trade deficit, which reached record $10 billion in the 6 months through June. Now, the European Central Bank will consider the economic situation before deciding whether to press ahead with another big interest rate hike in September, policymaker and fiscal hawk Robert Holzmann said on Sunday. The ECB was balancing its wish to tackle high inflation with a worsening economic situation because of problems like the Ukraine conflict. Osman said the economy will grow less strongly, and that has made the ECB to cautiously study its trajectory before deciding if it will do another 0.5% or less. Now, the ECB raised its benchmark deposit rate by 50 basis points to 0% on Thursday, its first hike in 11 years, as it joined global peers in jacking up borrowing costs. Britain's national grid was forced to issue an emergency appeal to Belgium for energy to keep its light on as the market was roiled by surging prices ahead of a looming winter crisis. The power network's electricity system operator issued an emergency instruction to operators of the Nemo cable running between Belgium and UK to make sure supplies were sent to Britain last week after failing to secure enough in the normal market. Now, the grid's notice came when gas supplies are expected to be under far more severe pressure, and Vladimir Putin, the president of Russia, may cut off shipments to Europe altogether. Let's also tell you that oil declined at the start of the week as concerns about an economic slowdown overshadowed signs of a tight fiscal crude market. West Texas Intermediate fell below $94 a barrel after capping a third weekly decline on Friday, the longest streak of losses this year. The Federal Reserve is expected to approve another big interest rate hike this week as the central bank combats surging inflation, piling pressure on demand. The oil market has seen bouts of volatility recently, characterized by sharp swings and low liquidity as investors juggle competing supply and demand outlooks. Crude is up around 25% for the year, although futures have given up most of the gains seen after Russia's invasion of Ukraine in late February. In the meantime, gold declined after posting the biggest weekly gain since May as investors weighed prospects for tighter U.S. monetary policy and concerns over an economic slowdown. Bullion hit the lowest level since March 2021 last week, only to rebound as U.S. Treasury yields eased. After raising rates in June by the most since 1994, Federal Reserve policymakers are expected to approve another 75 basis point hike when they meet between July 26 and 27. Gold is heading for a fourth monthly loss as Feds tighten and a stronger dollar deem its allure as a haven, overshadowing concerns about inflation and a slowdown. And those are the stories from the international business scene. We will continue with our conversation this morning. And now, Kenya is bracing up for fiscal reforms with help from the International Monetary Fund in order to keep its economy afloat after severe COVID-19 induced debilitating impact that grossly affected its economy. So we'll look into this after the break. Stay with us. We have more to come. Kenya, like many other nations, were severely impacted by the COVID-19 shock. The second quarter of 2022 saw a significant decline in Kenya's economic activities as a result of the disruption to international trade and travel, as well as the containment measures put in place to stop the virus spread. Curfews, school closings, and limitations on public gatherings all changed daily life, and some people lost their employment and many more experienced pressures due to income losses. This pressure resulted in significant hardship for the most defenseless. A number of decisive early measures were taken to support the economy in the wake of this unheard of shock, including immediate temporary reductions in personal and corporate income taxes, a temporary drop in the rate of value-added tax from 16 to 14%, and budget changes to make room for increased spending on social and health care. With low interest rates and liquidity injections to ensure the smooth operation of Kenya's financial system continues, the Kenyan Central Bank helped soften the shock. Additionally, it compelled banks to give debtors the option of delaying loan installments. Mobile money transaction fees were temporarily eliminated, which resulted in lower costs for consumers and encouraged the switch from physical cash exchange to a safer form of payment. Those were part of the critical reforms Kenya initiated to try get it back on track. So joining me from Nairobi, Kenya is Dr. Iraki, Faculty of Business and Management Sciences, the University of Nairobi. Good afternoon to you. Doctor, thanks for joining us on Business Edge.
Good afternoon. How are you? How is Victoria Island?
Beautiful. Thank you so much. So let's get into the discussion. Now, when a country borrows from IMF, the government agrees to adjust its economic policies to overcome the problems that actually led it to seek for financial aid in the first place. So these policy adjustments are conditions that IMF puts down before it gives the loans, and it serves to ensure that this country have the capacity to pay back those loans. So tell us, do you think that Kenyans are prepared for these conditions? Do you think that the government will be able to follow through with these conditions so that they will be able to pay back on their loan, looking at the fact that we are even in an election year?
I think that's a very interesting question, considering that in about 2 weeks' time we are going to go to the polls. And if you listen to the political contestants, none of them is talking about IMF conditions because they know they are very controversial. So if you look at the other times that IMF have come to Kenya and given conditions, the conditions were not very politically palatable. They might have made a lot of economic sense, but politicians may not like it. If you tell people to start paying more taxes, if you tell people to start losing jobs, being retrenched or being told to go home, that is not what any government wants. So I think the government wants money from IMF, but when it comes to the conditions, I don't think the politicians will be in a hurry to implement it. What I think is the current government will not implement most of those particular conditions, and it will be left to the next government after August 9th to implement those conditions.
All right, then, Doctor, one reform and said to be most all-encompassing is the fuel subsidy being paid by the Kenyan government. It's one of those things they're trying to do to control the economic quagmire that they are in. But then tell us, do you think that they will be able to what is the expectation basically as regards the removal of the subsidy, something that they will be doing very, very soon? Do you think they'll be able to do that? And if they do that, what impact do you think it will have on its purse and the economy?
I think the IMF has given the Kenyan government a deadline of October to remove all subsidies on fuel. And to me, that would be a very risky political decision and economic decision to make. Because as we talk now, the price of fuel is about $1.59, which has made everything become very expensive. If you go to hotels, if you take a bus, if you go for any services, they are telling you the prices have gone up because of fuel prices have gone up. So if the subsidies are removed, I expect inflation to go up significantly because of that. But I think the government might delay that decision because of the expected socio-economic effect on most of the Kenyans.
So you said that the price of fuel has gone up and that has inadvertently affected the price of commodities in the market, basically talking about inflation. But then looking at the issue, would you say that Kenya has local refining capacity, or do you think they should have? Because at this time, what is needed is to ensure that if they're going to pay back the loan, then they have what it takes in terms of financial capacity or sources whereby they can get those loans to pay it back. And aren't you thinking that by this time, they should be thinking about collaborations with other African countries if they are hoping to revamp the oil industry?
The oil industry in Kenya is a bit controversial because we discovered oil in 2011, but we don't have a refinery. In fact, most of the petrol and most of the diesel, most of the kerosene that we take in this country is imported. And maybe that would be a very good suggestion that in the long run, we could talk to Uganda, we could talk to Tanzania and build a common refinery so that the fuel that we consume in the East African region comes from within this region. I think that way would bring down the cost of fuel and by extension, the cost of refinery or the cost of most other commodities, because the price of petrol, the price of diesel, the price of kerosene always bring about inflation. So I agree with you, there should be more cooperation among East African countries, not just in petrol, but also in gas. Tanzania has a lot of gas, Uganda has some oil, Kenya has some oil, so that if we can have some refining capacity, we can benefit from economies of scale, bring down the cost of fuel, and by extension, tame inflation. But that might not happen overnight. It might take some time before we sit together and agree on such type of cooperation.
All right, now the World Bank and the IMF have gained a bigger say in government policy after Kenya turned to the multilateral institutions for concessional loans. And the intended reforms from the IMF for these current facilities will not be limited to fuel subsidies alone, according to what we know. The multilateral lender is saying that the University of Nairobi cut faculties from 11 from 35 and plans to trim further its current 324 courses. So in the process of this trimming down, don't you think it is counterproductive for Kenya's labor force and of course its overall economy?
I think it's counterproductive because if a country has developed, then we must produce enough manpower in every area to run the economy. So when you start cutting down the faculties, the departments, the country might not produce enough manpower to run its economy. So I think it's counterproductive. But you have to look at it the other way around, that IMF is looking for efficiency. You're saying you have this university, you have this company, you have this parastatal, you need to make it more efficient. So what might happen in the long run is that the universities and the parastatals might cut their staff, might streamline themselves, but that might be the pain before things change. So we hope that if the IMF conditions are implemented, the universities and other parastatals are going to become more efficient, and then they expand and probably create more jobs in the future. But remember that cutting the number of employees is politically very sensitive in this country. Remember, unemployment is very high. So I think the IMF reforms might be very good economically, but not politically. And so, I'm sure they will be resisted. So
are we looking at a possible industrial action if this continues or if this goes on?
I don't think we can talk about industrial action because the government has not actually implemented any job-cutting measures. I'm not aware of university staff that has been retrenched, particularly the members of teaching staff. They might have reduced the number of non-teaching staff, but the teaching staff have not been cut. And I think that is where you'll find a lot of hassling, you'll find a lot of struggle between the government and the employees if we come to that. But we haven't got into that yet.
Doctor, let's quickly look at the tourism and aviation sector of the country, Kenya, that we're looking at. Now, according to what we know, Kenya Airways has been earmarked for restructuring following the IMF deal. It has also upped its turnaround measures, trimming flights and routes, trying to slash salaries and cut down on workforce so that it's able to manage its operations. Now, do you think that the airline can survive?
I think the airline is going to survive, but what is going to happen is going to be leaner and probably mean airline. It will probably fly to fewer cities, maybe international and locally, but I think the government has had plans to make sure that Kenya Airways does not collapse. They have been giving them subsidies, they have been giving some financial aid. So I think Kenya Airways will survive, but it will be a more leaner and more meaner company as I put it. I think the government sees Kenya Airways as so strategic, as very important to the national pride. I don't think they are going to allow it to collapse. They will reform it and probably make it fly again as a pride of Africa, as we call it.
All right, so finally, Doctor, in terms of debt repayment sustainability, what do you think Kenya should do? Fine, it has come up with different reforms, different measures that you are also saying might not really work the situation. So what do you think they can do in terms of sustaining the debts and probably getting out of that economic quagmire?
I think that the next president of this country is going to face the first problem, which is debt repayment. Kenya has been accumulating debt for the last 10 years. And you can be sure that when the next president gets into office, you'll have to ask, how are we going to start paying this debt? And I see it in two ways. One of them is to make sure that the taxes are raised. That's what IMF has been saying. So I expect maybe the next government to raise some taxes. And number two is to reduce the waste. There's a lot of waste in local national government that can be reduced. And if that is reduced, then we can start living within our means. And number three, I forgot, is to make the economy more productive so that we produce more, we sell more, and we're able to get enough revenue, not just to cater for the salaries and wages, but also development projects. And that way we will be able to pay our debt because we assume that the debt we get is used for improving the productive capacity of the economy. So there are possibilities, but some of them are painful, some of them are short-term, others are long-term. But I think debt is an issue every government must face, whether the current government or the next government.
All right, definitely something that have to face and come up with solutions that can help them in that space. Well, thank you so much, Dr. Iraki, for joining the conversation.
Thank you and have a good afternoon.
Good afternoon to you too. Now, it is believed that a strong recovery for Kenya's economy is underway, although global shocks due to spillovers from the war in Ukraine are creating new spending needs and adding to inflation pressures. However, economists are of the view that Kenya's program is and will continue to deliver resilience by helping the country navigate the global shocks while still continuing to make progress in addressing debt vulnerability. So that is the discussion. That is the second discussion on the show this morning. Let's quickly run off on a break. And when we return, it will be time for NC4 to watch. On NC4 to watch, let's tell you that Kenya has received 30 billion Kenyan shillings, that's about $255 million from the U.S. Agency for International Development to fight the effects of drought and boost food security. Rwanda has joined the green list of the International Union for Conservation of Nature to acquire higher standards of conservation of nature and wildlife. A memorandum of understanding has been signed between Rwanda Development and IUCN recently. The African Common Position on Energy Access and Just Transition, which charts the continent's short, medium, and long-term energy development routes, has been endorsed by the African Union Executive Council as part of its ongoing commitments to environmentally friendly solutions. The goal is to hasten the transition to universal energy access while maintaining the need for development. And finally, the year-on-year producer price inflation rate provisionally inched up to 38.0% in June from 33.3%, the Ghana Statistical Service revealed. The June rate represents a 4.7 percentage points increase in producer inflation relative to the rate recorded in May 2022, which stood at 33.3%. And that is the size of our package on business news, our business edge rather, for this morning. Thank you so much for being a part of it. Definitely will bring you another edition tomorrow. But do not forget that you can visit our website at www.newscentral.africa. You can also download our mobile app on App Store and Play Store and look at our social media handles at News Central TV for more juicy details that I have for you there. My name is Lekono Mbanjo. Have a fruitful Monday.